If the market crashes today, here are 3 things that you can do to keep earning money, even if the market is 20, 30, or even 40% down in the red. In today's Invest With Me video, let's talk about 3 things that we can do to keep earning money, even if the market is down. If you're new here, my name is Ron and welcome to Pinoy Stock Investor. But before we start, let me know down in the comments, what company are you holding with 100% conviction this year? It'll be really interesting to know. Okay, let's start with a market check. All right, looking at the market, right now we have a mixed market. The S&P 500 is down by 0.32%. Dow Jones is up by 0.01%. QQQ is also down by 0.71%. Okay, now let's look at the portfolio. Portfolio is looking red right now, and we are down by 0.70% or $1,288. And looking at the taxable account, right now we are down by 0.91%, which is $1,100. That's a pretty big number. And since the market is going down, this is a really time to talk about how to make money during a market crash. I'm not predicting that the market is crashing, but it's really great that you're still making money even if the market is red, right? Okay, let's start. How much are we going to invest today? Okay, today we are going to invest $150 plus an additional $46 with the dividends that we received from Microsoft. Okay, then it looks like the taxable account is in the mix today. Okay, let's set this up. Okay, Apple, Amazon, Berkshire Hathaway, Google, Microsoft, Meta is currently down right now. And MasterCard and Uber is the ones that putting our portfolio in the green. Okay, right now we'll look at, we're ready to invest. Let's start with Uber. Okay, starting with Uber. But actually before that, let's put this investing budget to our Google Sheet. We have $150 additional. We're going to add the $46 from the dividends. So it's $196 in total. Okay, with $196, we're going to invest $19.6 to industrial services, and we're going to invest $20.58 to financial services. For communication, we're going to invest $29.4, and for technology, we're going to invest $25.48. Okay, right now we'll start with Uber. Okay, so Uber is we're currently down by $645, which is 8.11% in the total loss for Uber. And we are going to invest $15 to Uber. Okay, let's start investing. Okay, that is $15 to Uber. That is 0.204 shares of Uber. Next is MasterCard. We are going to invest. Okay, right now we are down by $452 in MasterCard, which is 7.04%. We are down by 7.04% total loss from when we started investing in MasterCard, and we are going to invest $15.75. And $15.75 is 0.031 shares of MasterCard. Next is Meta. In the total loss, also we are down by $236 in Meta, and that is negative 3.79% of Meta. Okay, we're going to invest $30 in Meta because we're trying to build this position. I'm trying to increase my position in Meta as much as I can, because right now, in my opinion, that Meta is actually a buy for me. And This is the newest position in the portfolio. I mean, I bought this a couple of months ago, but still the newest position in the portfolio. So $30 is 0.048 shares of Meta. So that's our first three companies that we're going to invest today. Now, one of the things that will make us money when we experience market crash, or when the market is down, or when the market continuously to go down, like the past few months, some of the things that I've noticed that a lot of investors, or the market, what the market is doing is pivoting to a more defensive kind of assets. So when the market crashes, capital often flows out of risky growth stocks and it moves to safe haven stocks or the defensive stocks. You can prevent major losses by shifting your portfolio or moving portions of your portfolio to a defensive sector like consumer staples, healthcare, or utilities. So these are the sectors that usually gets hit less, or it moves a little less. It still moves lower, but it moves a little less compared to hyper performing growth stocks like Meta, Uber, per se. Google is also up in there, and all those stocks, tech stocks that or AI stocks for like this year. You would see the difference on how much movement they went from the high, from their 52-week high to the 52-week low. Is like it's super fast. But in defensive, or in defensive assets or safe haven assets like these sectors, consumer staples, healthcare, utilities, they move a little bit lower or slower than compared to the other stocks. So these companies often maintain steady earnings even during recession. So look for companies with fortress balance sheet. So like the balance sheet is really solid. So companies with low debt, high cash reserves, or even the companies with history of maintaining the dividends during previous crashes. So companies with like Coca-Cola, Pepsi, which are dividend kings, and they have like a fortress kind of balance sheet wherein they didn't budge, or they didn't stop their dividends, and they have low debt and they have high cash reserves. So they were able to protect themselves. That's why they're defensive. So if you are overexposed to speculative or pre-revenue startups, I think this is one of the things that you should consider, and rebalancing it to a more blue chip stocks with durable cash flow. So these are not financial advice, and make sure to consult your own financial advisor before making any financial decisions. Okay, let's move forward to the next companies that we're going to invest in. These are Google, Berkshire Hathaway, and Apple. Okay, let's start with Google. Okay, right now, in total gains for Google, we are currently up by $9,334, which is 78.36%. And we are going to invest $20. Okay, that is $20. And that is 0.066 shares of Google. Next is Berkshire Hathaway. We are currently up in Berkshire Hathaway by $5,914, which is 37.46%. And we are going to invest $20 to Berkshire Hathaway. So $20 is 0.04 shares of Berkshire Hathaway. Next is Apple, and for Apple, we are going to invest we're going to invest $20 to Apple, and that is 0.079 shares of Apple. Currently, we are up in Apple by $8,314, which is 57.78% of our current holdings. All right. Next thing that you should do when you are trying to keep earning cash while the stock market is in the red is you implement a cash ready cash management plan. What is cash ready cash management plan? One of the biggest reason people lose money in a market crash is that they are forced to sell their stocks at the bottom. So they're realizing the current position, which is already lowered because it's already at the bottom and they have to sell it. So they're realizing those losses. And the reason for realizing those losses is to cover personal expenses. And preventing this requires a specific cash strategy. So one is to create a cash buffer. This is not an emergency fund. Cash buffer is different from your emergency fund. The sole purpose of this is to buy opportunities. So this cash buffer is what you use when the market is down. If you see the market is down and you have 100% conviction in a stock and you don't sell anything just to buy that stock, or you don't use money that is invested to buy your opportunities or to cover your expenses. You use that cash buffer fund that you built for these kinds of situations. So you're able to deploy that cash buffer to buy those opportunities or to cover those expenses that are caused by these kinds of crash or by these kinds of situation. Having this cash buffer fund prevents you from tapping into your long-term investments. There's no standard way how to do or how much you should save for your buffer fund or cash buffer fund that is separate from your emergency fund. Okay, but keep at least 2 to 3 years of your living expenses covered by this kind or by this fund. You can keep them in cash or in liquid cash, or you can also put them in short-term treasuries, so at least they're earning their money. This gives you the psychological and financial freedom to let your stocks or you let your portfolio recover without needing to sell them or liquidate them. And in this kind of situation, try not to take any more debt. So you don't need to get any commitment, or you don't need to get any more or to increase your debt in this kind of situation. Because having this cash buffer fund or crash buffer fund helps you to be more profitable in a red day like this or in a market crash, because you have the budget to buy all those clearance sale that's happening in the market. Take advantage of that prices that are going down. You're able to deploy this cash to buy or increase your position. And if it so happened that you need a liquid cash for your personal expense or just, let's say, just life itself, you don't need to liquidate those assets, those long-term investments, to cover these expenses. Okay, let's get back to our investments. There are only two companies that we're going to invest. It's Microsoft and Amazon. Let's start with Microsoft. Okay, Microsoft, we are currently up by $3,455 or 20.51%. And I want to increase my position in Microsoft since, in my opinion, it's heavily discounted right now. And so I put more resources to Microsoft recently. Okay, we are going to invest $40 to Microsoft. Okay, $40. So we're going to invest $40, and that is $0.10 shares of Microsoft. Okay, next will be Amazon. So click refresh in there. Okay, next is Amazon. We are going to invest the rest of the investing budget to Amazon. Right now, we are currently up by $937.10, which is 6.88%. That is our total gain from Amazon. And we are going to invest $37.49 to Amazon, which is 0.18 shares of Amazon. Since the market is down right now, I've been aggressively dollar cost averaging to my portfolio. This is one of the things that I do personally to keep earning money even if the market is down. I did this before back when there was COVID. I did this before back in April last year when there was a downturn, and now I'm doing it again while the market is practically on sale. Instead of selling when the price drops, I do the opposite. Like, a crash is essentially a store-wide sale of the stock market. The stock market is right now, they're flashing red. They're like, if you're in a mall right now, you would see sale sign everywhere. That's just my opinion, okay? Maybe it's a different opinion for everybody else, but in my opinion, right now, the stock market is on sale. And with this sale, I aggressively dollar cost average to my positions. And by increasing your buying frequency, or the amount of dollar cost average, or the amount of buying that you're doing during a crash, you lower your average cost basis significantly. I'm able to pull down my cost basis to the stocks that I have a lot of conviction because of this sale. I'll just label it a sale instead of market crash. But yes, because of the sale. This actually lowers your average. If you bought a stock at $100 and it crashes to $50, buying more at a lower level price brings your break-even point down. You will return to profit much faster when the market recovers. Now, things that you should do when you're doing this aggressive dollar cost averaging is to remove your emotions from your investing. So you don't wait for the bottom, because the bottom never comes. You would never see that it is the bottom until it is the bottom. So don't wait for it. You buy as the market goes down. So as the market goes down, I keep buying regularly, like $10 here, $10 here, $15 here, $5 here, as the market goes down. And you can say the same thing when the market goes up. So it doesn't mean that the market is going up, you stop buying. You can just aggressively dollar cost whether the market is up or down, because it fluctuates and you never really know what the bottom or where the bottom is once it really hit the bottom and it surge up. So one thing that you can do to maximize or to keep earning money in this kind of situation is to look at your strongest conviction. You can't be looking at the whole portfolio. Just look at your strongest conviction. The stocks that you, or the companies that you want to hold or you plan on holding for at least 10 years. At least 10 years, okay? You can see the conviction in there. Like, you put this amount of money for this amount of time and you hold it because you believe in this company. Okay, now double your monthly contribution during this month when the market is down more than 10%. If you see that the market goes down more than 10%, that is already a crash, or that is already a pull down. 20% and it's a bear market. But you can't really time it. That's the thing. You can't really time it. So you just double your monthly contribution during this time, and you can see that it really brings down your cost, or your average cost, or your cost basis. And that's what it did for me. Okay. It might not happen to you, or your situation might be different, but I'm doing this as an example based on what I did, based on what worked for me. And whatever worked for me might not work for you, but it's a good example. There's always an opportunity whenever a market changing events happen. pullback, correction, bear market, or even a market crash is something that an investor shouldn't be afraid of, because this is a part of a market cycle. Now, understanding each of the companies that you bought prepares you as an investor to any market condition. As long as there's no drastic change in the story of the company that we bought, there's nothing really to be worried of. Besides these three ideas that we talked about earlier, the best thing to do is really to just weather the cycle till the market bounce back. Or in other words, we can just do nothing. We don't need to sell, we don't need to buy, just weather it. If you get value in this video, don't forget to subscribe and like this video. It's free and it will definitely help my channel, which I'm very thankful of. Thank you for supporting me and for watching up to this moment. Have a great day and peace.